Just listening to Steve and just thinking about geopolitics, obviously the UMich survey from last week, China feeling the impact of the variant, a taper. What are the reasons to buy dwindling here?
So I don't think that the reasons to buy are dwindling. I mean, I fully understand what's kind of muting consumer optimism in the current environment. You have lots of cross currents that I think people are just feeling a little bit unsure and a little bit unsettled. But importantly, when we look at the U.S. economy, more importantly, when we look at the outlook for corporate profitability, we still think that the fundamentals are supportive of taking risk in portfolios. And, I would go as far as to argue, and going back to something that Steve said, there is an expectation here that the next couple of jobs reports should be pretty good. There's some rumbling that perhaps inflation has peaked on a year-over-year basis. And so it feels like things may start to improve here from a sentiment standpoint going forward. And if that coincides with very robust economic data, we see room for rates to move higher. And we think that cyclical value and value equities more broadly can rally against that backdrop.
Samir, do you think that the market is positioned to anticipate a more aggressive tapering timeline that Steve laid out?
We'll have to see. Clearly it's kind of, 2.0 in terms of we've gotten taper before. So hopefully markets are prepared this time around. But, really it is all about kind of a handoff from liquidity, which is what we basically experienced for the last, call it 18 or so months, driving markets higher to, whether there's actually some real growth there. And we think so. We think it'll take longer for some of these economic data to kind of mean revert. But at least the way the market's pricing it, when you look at interest rates and some of these other areas, the market thinks that slowdown will happen a lot faster. And that'll probably be the debate that kind of plays out over the next 3 to 6 months.
David, what's your expectation with regard to the 10-year? Does tapering indicate that we could see a rise in yields that everyone's been waiting for in light of what's been going on with the inflation picture?
So I think what's so interesting is if you go back and look at the playbook from the prior cycle, actually the tapering announcement, didn't really end up pushing rates higher. But that seems to very much be the expectation that perhaps that will catalyze a move in rates here into the end of 2021. To me, it's much more about the global growth story. And, you guys mentioned the numbers out of China earlier this morning being somewhat disappointing. Obviously, Delta is a much bigger problem for the world than it is here in the United States and other parts of the developed world more broadly. And so to me, if we can get some signals that, the things are beginning to improve outside of the United States, outside of Europe, I think that's really going to be what catalyzes rates higher. And we still think that we finish the year closer to 2% rather than 1%. I think 1.75 by year end is a very reasonable expectation.